Every empire believes its money is different. Spain stamped its silver with royal crests and called it eternal. The coins moved in chests across oceans, counted in candlelit warehouses from Seville to Manila. Contracts were written in them. Wars were financed with them. For 3 centuries, if you wanted to move serious wealth across borders, you did it in Spanish silver. It felt permanent, like gravity. Then the silver stopped being silver. To fill a growing gap between what the empire spent and what it earned, the metal was thinned, diluted, mixed with cheaper alloys. On the surface, nothing changed. The stamp was the same, the king's face was the same, the unit of account kept the same name, but underneath, the substance was quietly disappearing. Prices drifted higher, trust drifted lower, and a currency that had once been treated as solid as the metal inside it became a question mark. The Dutch watched this happen and thought they could do better. In the 17th century, Amsterdam turned money into a system. Ledgers, joint stock companies, a central exchange, a sophisticated network of credit that used the guilder as its language. Capital from all over Europe flowed into this new financial machinery. The guilder became what the Spanish dollar had been. The unit you settled serious trade in, the benchmark others measured themselves against. But the pattern did not care that the Dutch were more clever. They, too, discovered the temptation that comes with global trust. The ability to fund distant wars, ambitious fleets, and domestic comfort not just with taxes and trade, but with promises, claims on the future written as money today. Slowly, the liabilities mounted. Debts that assumed tomorrow would always look like yesterday. When that future didn't arrive, the financial center of gravity shifted again, and the guilder faded into history. Then came the British pound. For over a century, sterling sat at the center of the world's clearing system. Insurance contracts at Lloyd's, trade finance in London banks, war loans, colonial administration budgets, all denominated in pounds. The British Empire built railways, ports, and telegraph lines with a currency that the world treated as almost risk-free. Gold sat behind it. The Royal Navy enforced it. London's bond market spread it to every continent. And still, the pattern waited. 2 world wars, financed with debt and money creation on a scale no previous empire had attempted, shattered the balance. The same dynamics repeated. Extraordinary spending justified by extraordinary circumstances, followed by a refusal to fully reverse any of it. The pound survived as a symbol long after it had lost its substance. By the time delegates gathered at Bretton Woods in 1944 to design a new financial order, the conclusion was obvious. The world could no longer rest on sterling. It needed a new anchor. The United States stepped forward, gold in its vaults, factories that had not been bombed, an economy that had geared up for war and could now be redirected toward global trade. The dollar took the throne that the Spanish dollar, the Dutch guilder, and the British pound had each briefly occupied. The world's invoices, reserves, and debts would now be written in US dollars. The Federal Reserve sat at the center of a system no previous central bank had controlled at that scale. Every one of those earlier currencies believed they were permanent. Every one of them failed. That is not a metaphor. It is a record. Beneath each collapse sits the same structure. A government or empire discovers that as long as the world trusts its money, it can spend more than it earns. It can fight wars without raising visible taxes. It can maintain living standards at home while leverage and obligations stack up in the background. As long as the currency is accepted, the bill can be rolled forward. And as long as there is a central institution, an early treasury, a bank of issue, a sophisticated central bank that can manufacture new money or new credit, the pressure can be relieved without admitting failure, for a while. At first, the interventions look like solutions. Debasement stabilizes an overstretched treasury. New borrowing carries a country across a crisis. Print money in a controlled way. You avoid immediate collapse. Lower interest rates, credit flows again. The system recovers. But each of these solutions does something subtle and catastrophic. It makes the next crisis bigger. The Spanish crown diluted the metal content of its coins to keep paying its armies. The Dutch piled up debts they assumed growth would cover. Britain issued war loans and quietly detached the pound AS promises from the hard limits of its gold reserves. Each time, the architects of the system told themselves they were defending stability. Each time they were trading long-term solidity for short-term survival. There is a pattern behind every reserve currency collapse, and it is not mystical. It is brutally simple. First, excessive money creation in one form or another. The units multiply faster than the real wealth underneath them. The coins contain less silver. The notes represent claims on production that will never materialize. The digital balances expand on central bank ledgers faster than the underlying economy can justify. Second, unsustainable debt. Obligations that look manageable when interest rates are low and faith is high become unpayable when either moves. Governments borrow not as a bridge through temporary hardship, but as a permanent way of life, assuming someone in the future will solve a problem they are still adding to. Third, military overreach. Global reach, bases, fleets, and alliances cost money. A lot of it. The temptation to project power abroad is strongest for the country whose money everyone else is holding. The world funds the empire's ambition by accepting its currency, and that currency's status is justified by the empire's ambition. A loop forms. Eventually, it snaps. Fourth, erosion of the productive base. As long as the rest of the world wants your currency, you can afford to import more than you export. Factories close. Supply chains move offshore. The nation that issues the reserve currency begins to live above its productive means, paid for by other countries' willingness to hold its paper. Fifth, denial. This might be the most important feature of all. The people inside the system, from citizens to policymakers, cannot imagine the anchor breaking. They have never lived in a world where it was different. Newspapers, textbooks, and everyday experience all reinforce the same assumption. Our money is special. Our position is permanent. History says otherwise. The pattern says otherwise. But the narrative holds until it stops. Those 5 elements are not abstract talking points. They are a checklist you can run against any empire that has ever held the reserve currency role. Run it against Spain, it fits. Run it against the Dutch Republic, it fits. Run it against Britain, it fits almost too well. Now run it against the United States. The Federal Reserve's balance sheet, which once reflected a constrained, conservative central bank, has exploded in size over the last 15 years. Less than $1 trillion in assets before 2008. Multiple trillions today. Trillions more conjured in crisis, labeled with technical terms that make printing sound surgical and temporary. Quantitative easing, liquidity injections, facilities, programs. Names change. The underlying mechanism does not. New dollars created, new claims on a fixed pool of real goods and services. At the same time, the U.S. government's debt has grown beyond any plausible path of honest repayment. The numbers are no longer abstract. Tens of trillions, rising by trillions more every few years, financed in large part by the same central bank that is supposed to guard the currency s the value. Interest payments themselves have swollen toward a level that competes with everything else the government is supposed to do. Education, infrastructure, social programs, defense, all crushed into the margins of a budget, dominated by servicing yesterday's promises. Overlay that with a global military footprint that spans dozens of countries and consumes more resources than the next several nations combined. Add a manufacturing base hollowed out by decades of offshoring and a consumer economy that runs chronic trade deficits. And then finally, look at the prevailing mood. Confidence that the dollar will always be the world's reserve currency, that the United States will always be able to borrow cheaply, that the system, whatever its flaws, is fundamentally safe. The pattern is not forming. It is already formed. There is one more layer to this that turns concern into inevitability. The institutions in charge of maintaining the system know, in broad terms, what they are doing. They know that printing dilutes. They know that debt can become unpayable. They know that endless wars and global obligations have real costs. The problem is not ignorance, it is constraint. A central bank faced with a choice between allowing a brutal collapse now or postponing it with new money almost never chooses collapse. An elected government faced with a choice between admitting insolvency and borrowing more almost never chooses admission. The Spanish court did not. The Dutch regents did not. British cabinets did not. The Federal Reserve and the U.S. Congress are not exceptions to a rule. They are the current expression of it. If every reserve currency in history has walked the same path and ended in the same place, the obvious question becomes unavoidable. Why would this time be different? The honest answer is that this time is not different. It is simply larger. To see that, you have to go back to the moment when the dollar took the throne. In the final years of the Second World War, Britain was technically on the winning side and financially broken. 2 global wars in a single generation had drained its reserves, forced it to liquidate assets, and left it dependent on American support. The empire still stretched across the map, but the balance sheet behind the maps was finished. The United States was the opposite. Its factories were running, its homeland was intact, its gold reserves were unparalleled. Shipyards, steel mills, assembly lines. Industrial capacity on a scale no other country could match sat behind a currency that had not yet been tested by defeat or occupation. When delegates arrived at Bretton Woods in 1944, they were not really negotiating between equals. They were formalizing a reality. The British pound could no longer bear the weight of the world. The dollar could. The architecture that emerged from that meeting was both elegant and dangerous. Currencies would be pegged to the dollar. The dollar would be pegged to gold at $35 per ounce. U.S. treasuries would become the bedrock asset for central banks and institutions everywhere. If you were a foreign government running a surplus, you parked it in U.S. debt. If you wanted to trade across borders, you invoiced in dollars. If you needed to settle, you did it through the American system. For a time, this was anchored by real production. Post-war America made things the world wanted. cars, machinery, chemicals, electronics, food. The industrial base that had armed the Allies now turned out consumer goods and capital equipment for reconstruction and growth. The rest of the world needed dollars because it needed American output. The reserve currency status reflected genuine economic dominance. But it also created a new dynamic, one no previous empire had experienced at this scale. The more the world relied on dollars for trade and reserves, the more dollars the world needed. To supply those dollars, the United States had to run deficits, spending more abroad than it earned, sending its currency out into the system. In practice, that meant rising government deficits, rising private credit, and an ever-growing mountain of U.S. liabilities held overseas. By the 1960s, the numbers no longer lined up. The volume of dollars circulating globally and the promises made in those dollars had grown far beyond what America's gold reserves could honestly back. Foreign governments could, in theory, show up and demand metal. In practice, if they all did it at once, there wasn't enough. The system depended on most participants never asking for redemption at the same time. Some did. France famously called the bluff and demanded gold for its dollars. Others followed. The pressure built. The architecture designed at Bretton Woods, gold as the final anchor beneath the dollar, was incompatible with the amount of credit the system now needed to function. In August 1971, the United States quietly chose. President Nixon announced that foreign governments would no longer be able to convert their dollars into gold. Formally, it was a temporary measure to defend against speculators. In reality, it was the end of the last hard constraint on the reserve currency. The dollar would no longer be a claim on a fixed quantity of metal. It would be a claim on whatever the United States decided it would be, backed not by a promise to redeem in gold, but by a promise to accept those same dollars for taxes and debt. The anchor broke, and the system did not collapse. It adapted. Oil producers began pricing crude in dollars, reinforcing global demand. Financial markets innovated, creating new ways to hold, trade, and leverage dollar assets. The United States enjoyed what economists call an exorbitant privilege, the ability to borrow in its own currency from the entire world at interest rates lower than almost anyone else in quantities that would have been unthinkable for any other country. This is where the pattern deepens. When money is tied to something finite metal in a vault, for example, there's a natural upper bound on how far you can stretch claims on the future. You can still cheat, still debase, still overpromise, but the gap between appearance and reality has limits. When the reserve currency is pure fiat, unmoored from anything tangible, the only real constraint is confidence. Confidence is easier to manipulate than gold. Politicians learned that they could run larger deficits without immediate punishment. Central banks learned that they could cut interest rates to rescue markets, knowing that more credit could always be created. Voters learned that much of the cost of government programs, wars, and safety nets could be hidden in future inflation rather than current taxes. Over time, the memory of any other way of doing things faded. By the early 2000s, the world had grown used to a dollar system that seemed indefinitely expandable. Debt levels rose across governments, corporations, and households. Derivatives and structured products layered additional claims on top of already leveraged positions. The U.S. financial sector ballooned into a central pillar of the economy. Leverage became normal. Then, in 2008, the system finally buckled under its own weight. Mortgage-backed securities, credit default swaps, highly leveraged banks' complex machinery built on the assumption that house prices would not fall nationwide and that liquidity would always be there seized up. Markets froze. Trust evaporated. For a brief period, the entire architecture of modern finance stood on the edge of collapse. The response revealed how the machine really works. The Federal Reserve cut interest rates to zero. It created new programs, new facilities, new channels to inject money directly into the financial system. It expanded its balance sheet from under $1 trillion to multiple trillions, buying government bonds and mortgage securities in quantities that would have been politically impossible in any previous era. The language was technical. The reality was simple. New money, created in digital form, used to support asset prices and keep credit flowing. It worked if your definition of worked is prevented an immediate depression. The banks were saved, asset prices recovered, markets breathed again, but the deeper pattern intensified. A precedent was set. When the system is threatened, the answer is to expand the central bank's footprint and flood it with liquidity. A decade later, during the COVID crisis, the scale of intervention broke even that precedent. In 2020 and 2021, central bank balance sheets and government deficits exploded together. The Federal Reserve created on the order of $4 trillion new dollars in a very short period, roughly 40% of all dollars in existence at that time, under the banner of emergency support. At the same time, fiscal authorities sent direct payments to households and businesses, expanded unemployment programs, and underwrote corporate credit. For ordinary people, the consequences did not show up as balance sheet charts. They showed up in price tags. Groceries that cost a certain amount one year cost noticeably more the next. Rents stepped higher and did not step back down. Used cars became shockingly expensive. Insurance, healthcare, education, utilities, line items that were already rising began climbing faster. Official inflation statistics, smoothed and adjusted, reported numbers in the low single digits, or briefly, the high single digits. Everyday experience told a harsher story. When more units of a currency chase the same or constrained supply of goods and services, the unit loses purchasing power. That is not ideology, it is arithmetic. By the mid-2020s, housing costs in many parts of the United States had risen on the order of 30 to 40% in just a few years. Food costs were up by double digits. Energy went through its own spikes and plateaus. The transitory language faded. The permanent reality remained. Households noticed, not as a chart, but as a feeling, the paycheck did not go as far. Savings accumulated over years, held in cash or low-yield instruments, could buy less. Against this backdrop, another line was steepening: federal debt. The United States now carries roughly $36 trillion of official national debt, a figure larger than its annual economic output. That number is not static. It grows by trillions more every few years, as deficits become the baseline rather than the exception. Interest payments alone have crossed the $1 trillion per year mark. That is money spent not on services, not on infrastructure, not on new programs, but simply to avoid defaulting on previous borrowing. This is where the trap becomes visible. Raise interest rates to fight inflation, and the cost of servicing the debt explodes. Keep rates artificially low to cheapen the debt, and inflation erodes the currency faster. Cut spending deeply enough to balance the budget, and you trigger a severe recession or worse, with all the political backlash that entails. Default outright, and you destroy the very trust that makes your currency useful as a reserve in the first place. Every path out of the maze carries pain. History suggests that democratic systems, especially those with a powerful central bank, tend to choose the option that hides the pain for as long as possible: monetary debasement. They print, they relabel it, they sterilize it with language, but they print. In previous reserve currency regimes, this debasement had a local flavor. The Spanish crown's coinage, the Dutch financial system, the British gold standard and its unraveling. Today's version is more global, more digital, and more intricate, but the essence has not changed. The question is no longer whether the pattern fits the United States. It does. The question is when and how the world begins to act on that recognition. For a long time, the rest of the world treated that recognition as impolite. Central banks kept large reserves in dollars. Commodity contracts were written in dollars. International loans, from sovereign debt to corporate borrowings, were denominated in dollars. The system had path dependence. The more people used it, the harder it was to leave. Even countries that resented American power still needed American money. But a reserve currency is not just a convenience. It is a point of vulnerability. If your trade, your savings, and your debts are all tied to someone else's monetary policy, you're exposed to decisions you do not control. When the Federal Reserve cuts rates, countries far from Washington experience capital flows and currency swings they did not choose. When it raises rates, they feel the tightening. When it prints trillions, they absorb imported inflation often, while lacking the political or institutional capacity to respond. For decades, this was tolerated because there was no credible alternative. The euro was new, internally fragile, and backed by a political union that was still contested. The Japanese yen belonged to an economy that had experienced its own financial bubbles and stagnation. China's currency was tightly controlled and not fully convertible. The dollar was imperfect, but it was liquid, ubiquitous, and backed by a deep, relatively transparent financial system. That is changing quietly. In recent years, large economies outside the traditional Western bloc have begun to build their own channels. China and Russia conduct trade directly in their own currencies. The BRICS group Brazil, Russia, India, China, South Africa, and an expanding circle of partners has discussed and begun constructing alternative payment systems and potential shared instruments to settle trade without defaulting to the dollar. This is not a cinematic overthrow. No single summit declares the end of the dollar. It is a process. One contract here, one bilateral agreement there, one central bank reducing the share of its reserves held in U.S. treasuries and increasing its holdings of gold. Over time, these seemingly isolated decisions add up to a structural shift. Gold is a particularly telling detail. For years, Western commentary treated gold as an anachronism, a relic held by eccentric investors and nostalgic central bankers. Yet many of those same central banks, especially in emerging markets and rival powers, have been buying more of it. Not because they expect to return to a strict gold standard, but because gold is one of the few assets that is no one else's liability. It does not depend on the promises of a foreign government. It cannot be created by keystrokes. When a central bank sells some of its U.S. treasuries and buys gold instead, it is quietly voting against the current architecture. It is hedging against the possibility that the anchor of the system is weakening. At the same time, key commodity exporters are experimenting with non-dollar pricing. When an oil producer accepts payment in another currency, especially one that can be converted into gold or used to purchase a diversified basket of goods, it is taking a step away from the petrodollar structure that has underpinned global demand for dollars since the 1970s. These moves do not have to replace the dollar entirely to be dangerous for it. They just have to reduce the necessity of holding it. The United States, meanwhile, behaves as if nothing fundamental is at risk. It continues to run large trade deficits, importing more goods than it exports, paying the difference with newly created claims: dollars, treasury bonds, financial products. Its manufacturing base, once the envy of the world, has been eroded by decades of offshoring. Supply chains for crucial goods, from electronics to pharmaceuticals, now stretch across geopolitical rivals and unstable regions. For an ordinary citizen, this shows up as a contradiction that is easy to ignore until it fails. Store shelves are full of imported products. Prices, despite recent spikes, still reflect a world where labor and materials in distant countries are cheap when translated into dollars. The illusion is that this arrangement is permanent. The reality is that it is contingent on the rest of the world continuing to accept those dollars without question. The military dimension overlays all of this. The United States maintains hundreds of bases and military facilities across the globe. Its defense budget exceeds that of the next several countries combined. Carrier strike groups patrol critical shipping lanes. Alliances and security guarantees stretch across continents. Every treaty, every deployment, every intervention carries a financial cost that ultimately flows back into the nation's accounts and, by extension, its monetary system. Historically, empires have justified this kind of reach by pointing to security, stability, and moral duty. There is always an enemy to deter, a friend to protect, a principle to uphold. Those reasons may be sincere or cynical or both, but beneath them lies accounting: ships, aircraft, salaries, fuel, weapon systems, logistics, pensions, all of it paid for with a currency whose value is assumed, never questioned. A reserve currency makes this kind of overreach easier. The world willingly holds your debt. Your interest rates remain low. Your deficits are absorbed by foreign buyers. You can postpone the fiscal reckoning in ways lesser countries cannot. Spain did this. Britain did this. The pattern is consistent. It is tempting, from inside such a system, to treat the rest of the world's willingness to hold your paper as a permanent feature of nature. It is not. It is a political and economic choice. And choices change when the costs and benefits shift. The costs are rising. When the Federal Reserve fights domestic inflation by raising interest rates, it is not just adjusting a national dial. It is tightening financial conditions for borrowers around the world whose contracts are written in dollars. When it floods the system with liquidity, it is not just supporting local banks. It is altering the exchange rate and asset valuations of countries that did not participate in the decision. From Washington's perspective, these moves are necessary tools of policy. From the perspective of other capitals, they are shocks imposed by a foreign institution. At the same time, internally, the United States faces a demographic and fiscal reality that narrows its options further. Large entitlement programs such as Social Security and Medicare are structured around assumptions made in a different era: different birth rates, different life expectancies, different debt levels. The trust funds that support them are trending toward insolvency timelines that converge with rising interest costs on the national debt. To maintain promised benefits while also servicing mushrooming debt, a government can raise taxes sharply, cut spending sharply, or finance the gap with more borrowing and more central bank support. The political system, divided and intensely focused on short-term cycles, has shown little appetite for the first two. That leaves the third. This is how a mathematical problem becomes a monetary problem. Project the current trajectory forward a few years, and you see why the 2025 to 2028 window matters. By the middle of this decade, U.S. federal debt is on track to cross $40 trillion. If interest rates remain elevated relative to the previous decade's near-zero norms, the cost of servicing that debt consumes a growing share of the budget. Every point of interest becomes hundreds of billions of dollars in annual payments. At the same time, alternative financial channels being built by non-Western blocs are likely to be further along. A BRICS-linked currency for trade settlement, even if limited in scope, will exist. More oil contracts will likely be denominated in non-dollar units. More central banks will have shifted a meaningful portion of their reserves into gold and into each other as currencies. The marginal demand for new U.S. debt from foreign buyers will be weaker. Overlay another cycle of financial stress: a commercial real estate downturn, a regional banking crisis, a geopolitical shock, and the pressure on the Federal Reserve to intervene again will be immense. Each intervention will likely involve more balance sheet expansion, more liquidity programs, more creative ways of transferring losses from private balance sheets to public ones. At some point, the rest of the world begins to draw a simple conclusion: the issuer of the reserve currency cannot and will not stop debasing. not because its officials are malevolent, but because the structure they oversee offers no painless exit. When that conclusion spreads far enough, the shift accelerates. Countries that had been content to hold large amounts of U.S. debt as reserves will decide they need less of it. They will shorten the maturity of the bonds they hold, reduce new purchases, or quietly sell into strength. Corporations that routinely borrowed in dollars will look for alternatives, even if those alternatives are less convenient at first. Commodity exporters will experiment with different pricing arrangements, especially if they can convert receipts into assets that do not lose purchasing power as quickly. Inside the United States, this will appear first not as a headline declaring end of the dollar, but as a series of seemingly disconnected symptoms. Funding U.S. deficits becomes incrementally more expensive. Auctions of treasury bonds clear at higher yields. The central bank finds itself buying more government debt, directly or indirectly, to stabilize markets. Inflation appears in waves that recede but never fully reverse. Then a threshold is crossed. The world no longer needs to accumulate new dollars, but still holds a vast stock of old ones. Those dollars exist as reserves on central bank balance sheets, as deposits in foreign banks, as cash balances held by corporations and investors. They were created during decades when the dollar was treated as the unquestioned backbone of the system. If enough participants decide those holdings are now a source of risk rather than safety, they will try to convert some of them into anything else: other currencies, goods, land, companies, gold. The flows that once moved outward from the United States to the rest of the world can begin to reverse. That is what it looks like when a reserve currency enters its final phase. Not a dramatic announcement, but a quiet change in direction. The river of money that once flowed outward starts to run back toward its source, bringing with it the inflation that had been exported for years. Too many units of currency, created over too long a period, begin to chase a finite supply of domestic goods and assets. The pattern that played out in Weimar Germany, in Zimbabwe, in other extreme cases of currency collapse, is not identical. Those were not reserve currencies, but the mechanism is similar. When confidence breaks and the stock of money held as a store of value tries to move at once, prices do not simply rise. They lurch. They run. They detach from the past. From the vantage point of an individual household, this does not present itself as an academic macroeconomic event. It shows up as a series of shocks: rent that doubles between leases, groceries that feel expensive one month and more expensive the next, wages that cannot keep pace, savings that shrink in terms of what they can buy, even if the number in the account does not fall. It shows up as a breaking of assumptions: pensions that prove underfunded, promises that cannot be honored in real terms, contracts written in nominal dollars that no longer correspond to the reality of what those dollars can purchase. And then, inevitably, it shows up as politics. When a currency fails, it does not announce itself with technical language. It announces itself with anger. People who did everything they were told, saved, worked, paid into systems, realize that the units they trusted no longer mean what they thought. Retirements that looked secure on paper are exposed as fragile. Food and rent take larger shares of income. Promises made over decades are quietly rewritten in devalued money. History is clear about what tends to follow. The social fabric frays: groups look for someone to blame. Governments blame foreign adversaries, hostile speculators, or previous administrations. Opposition parties blame the current leadership. Commentators blame corporations, or unions, or immigrants, or global conspiracies. Everyone looks for a culprit they can see, because the real architect, the structure of the monetary system itself, is abstract and impersonal. Protests become more frequent. Some are about specific issues: fuel prices, food costs, wages. Others are about institutions, corruption, austerity, perceived betrayal. In the noise, more radical voices find an audience. If the center cannot admit the scale of the problem, people begin listening to those who at least name their pain. A reserve currency collapse is not just an economic event, it is a political event, and often a constitutional one. The United States is not Weimar Germany, Zimbabwe, or Venezuela. Its institutions are older, its economy larger, its military more powerful. But the underlying logic of what happens when a population's savings are eroded by policy decisions they did not vote on is the same. The trust that holds a society together is not unlimited. Inside this environment, the Federal Reserve and the political class are not villains in a simple story. They are characters in a structure that gives them only bad options. If the central bank raised interest rates high enough and kept them there long enough to crush inflation fully, the consequences would be severe. Asset prices would fall sharply. Highly leveraged companies would fail. Housing markets would seize. Tax revenues would drop as recessions deepen. Banks, already exposed to interest rate risk and questionable collateral, would face fresh waves of insolvency. Unemployment would rise. The pain would be immediate, visible, and politically explosive. If, instead, the central bank keeps rates lower than inflation for extended periods and steps in to support markets whenever stress appears, another outcome unfolds. The currency erodes. Savers are punished. Speculation is rewarded. The cost of living rises in unpredictable jumps. The pain is slower and less theatrical, but it reaches more people. Governments face their own mirrored version of the same dilemma. Honest austerity, cutting spending deeply enough to match revenues, would require breaking long-standing promises to powerful constituencies. Benefits would have to be reduced, programs scaled back or eliminated, defense budgets cut. The immediate backlash would be intense. Elections would be lost. Parties would fracture. Attempts to reform entitlement systems already meet with fierce resistance long before any currency crisis becomes obvious. Defaulting on the debt is even more explosive. It would shatter the perceived safety of U.S. treasuries, trigger chaos in global financial markets, and likely end the dollar's reserve status abruptly rather than gradually. The very investors and governments whose continued cooperation is needed to roll over debts would be injured and alienated. That leaves the third path. Continue running deficits and ask the central bank, directly or indirectly, to support the bond market. Print in one form or another. Monetize, extend, pretend. This is not a conspiracy, it is an equilibrium. It is what happens when every other option is worse in the short term. The system chooses the form of failure that can be stretched out, managed, and disguised as long as possible. Spain chose it, the Dutch chose it, Britain chose it, the United States is choosing it now. Against this backdrop, the question shifts from can the dollar fail to how do ordinary people live through the failure of a reserve currency? Cash in such a world is not safety, it is exposure. Holding large amounts of a currency that is being steadily devalued is like standing still on a floor that is slowly collapsing. The numbers in your account remain the same. The reality beneath them changes. So the first step is conceptual. Understand that sitting in dollars without a plan is not neutral. It is a bet that the pattern of history will skip your generation. The second step is tangible. Shift part of your wealth into things that cannot be printed. For 5,000 years, gold and silver have played that role. Not as speculative bets, but as stores of value that persist through regime changes and monetary experiments. When paper and digital claims are being created at will, assets that cannot be conjured into existence serve as anchors. In the 1970s, as the dollar's link to gold was severed and inflation surged, the metal's price rose from roughly $35 an ounce to hundreds of dollars, reflecting not that gold had changed, but that the unit used to measure it had. Owning physical precious metals, coins, and bars you can verify and control is not a get-rich strategy. It is an insurance policy against the failure of abstractions. In a world where the reserve currency's trajectory is in question, allocating a significant share of long-term savings, perhaps 20 to 30% of investable assets, to gold and silver is not extreme. It is proportionate to the risk. Real estate is another form of non-printable wealth. Land and property have utility independently of the monetary unit used to value them. In inflationary periods, real estate prices often rise in nominal terms, reflecting the weakened currency. The danger lies in leverage. Buying property with large amounts of variable rate debt ties you to the very system that is under strain. A safer posture is to hold property with little or no debt, or with long-term fixed-rate loans locked in before interest rates spike further. Equities can also be a tool, but not in the indiscriminate way index investing has been sold in an era of cheap money. Companies that depend on financial engineering, constant access to low-cost credit, or purely speculative narratives are fragile when currencies wobble and rates rise. What tends to endure are businesses that produce essentials, energy, food, infrastructure, materials, utilities. Firms with real assets, modest leverage, and products humans cannot easily give up. Diversification across currencies and jurisdictions is a third layer of defense. If all your accounts, properties, and assets are denominated in a single currency under a single legal system, you are fully exposed to decisions made in one capital. Spreading some assets into countries with more conservative fiscal policies, more restrained central banks, or simply different cycles reduces that concentration risk. Holding part of your savings in currencies like the Swiss franc, the Singapore dollar, or others with stronger balance sheets and tighter discipline can soften the blow if the dollar stumbles. Foreign real assets, property, business interests, or even just bank accounts can play the same role, not because any country is immune to crisis, but because not all crises arrive at the same time or in the same way. On the frontier of this landscape sits cryptocurrency. Bitcoin in particular was designed explicitly as an alternative to state-issued fiat. Its supply is fixed by code. Its issuance schedule is transparent. No committee can vote to print more of it in response to a crisis. That does not make it invulnerable. Its price is volatile, its regulatory future contested, its technological risks non-trivial. But in a world where reserve currencies are visibly being stretched, a small allocation to an asset that cannot be devalued by policy may act as a hedge. Not everything you do in preparation sits in balance sheets. Skills, knowledge, and relationships are forms of capital that do not evaporate when a currency does. In periods of monetary upheaval, economies do not stop. They reprice. They reorganize. People who can create value in multiple ways, who can work across domains, adapt to new demand, and solve real problems, are less vulnerable than those whose livelihoods depend on a single, brittle niche sustained by cheap credit. Practical skills matter the ability to repair, to build, to produce. Professional skills matter understanding systems, managing complexity, leading, teaching, analyzing. Building more than one source of income reduces reliance on any single employer, sector, or geography. Community matters as much as capital. When currencies fail, trust networks take on new importance. Families, neighborhoods, professional circles, and local institutions become the channels through which information, resources, and support flow. Isolation amplifies vulnerability. Connection spreads resilience. A society under stress can fracture along every fault line, or it can absorb some of the shock through webs of mutual support. Individuals who invest in those webs before the crisis hits are not guaranteed safety. They are simply less alone. None of this is about panic. It is about acknowledging that the structure you live inside is not guaranteed to endure in its current form. Some will dismiss these concerns as alarmist. They will point to expert commentary, assuring that the dollar's dominance is secure, that debt levels are manageable, that central banks have the tools they need. They will note that previous warnings of collapse did not immediately materialize. They will argue that no other currency is ready to replace the dollar, as if the system must always have a single, unquestioned hegemon. They might be right about timing. They might be right about the system's ability to stretch further than it looks. But the risk calculation does not depend on perfect prediction. If you take steps to diversify, to reduce exposure to the most fragile parts of the system, and the dollar continues for decades without a dramatic break, you lose little. You own assets with intrinsic value. You carry less debt. You hold skills and relationships that are useful in any environment. You have options. If you dismiss the pattern, assume that this time really is different because it is yours, and the system breaks faster than expected, the losses are absolute. Savings wiped out in real terms, pensions impaired, careers disrupted, plans invalidated. From a purely rational perspective, the asymmetry is stark. The cost of preparing and being wrong is small. The cost of failing to prepare and being wrong is everything. Behind the numbers, behind the charts and technical language, this is what the pattern of reserve currencies really means. Empires rise, financial systems mature, debt grows, money is stretched, crises are papered over, and then, at a point no one can name in advance, but everyone can recognize, in hindsight, the illusion of permanence shatters. The Spanish dollar shattered. The Dutch guilder shattered. The British pound shattered. Each believed it was the exception until its final decade. Each had officials who insisted that their situation was unique, that historical comparisons were misplaced, that new tools and new sophistication had changed the rules. They had not. The Federal Reserve did not invent this problem. It inherited it. A central bank that sits at the center of a global fiat reserve currency with decades of accumulated imbalances is not a neutral technician. It is the caretaker of an exhausted model. When it prints, it is not just reacting to events. It is extending the life of a structure that relies on ever more credit to sustain itself. When it reassures markets, it is buying time in exchange for deeper eventual adjustment. When it promises to do whatever it takes, it is admitting, in different words, that there is no graceful exit. You live inside that timeline. You cannot vote on the existence of the debt that has already been issued. You cannot veto the money that has already been printed. You cannot individually reverse the offshoring of manufacturing or the expansion of military commitments. You can only decide how tightly you tie your own life to a currency and a system that are repeating a very old story on a very large stage. At the end of that story, one thing has always been true. Every reserve currency in history has failed. Not because of bad luck, or singular villains, or sudden shocks, but because the logic of using debt and money creation to sustain an empire eventually exceeds the capacity of any real economy to carry it. The names on the notes change. The stamps on the coins change. The flags above the institutions change. The pattern does not. The dollar will not be the exception. You're not powerless in the face of that fact. You are not required to stand still while the floor shifts. You can study the pattern, recognize the phase you are living through, and adjust. You can move some of your wealth out of abstractions and into substance. You can trade passive faith for informed caution. You can stop assuming that what has always been will always be. You cannot stop the machine, but you can step out of its blind spots. In every age where a reserve currency has approached its end, there have been two kinds of people. Those who clung to the old stories until they broke, and those who understood quietly that the stories were changing and acted accordingly. You know now which side of that divide you stand on?